If you want to know how the market is, really doing today, don't look at the stocks that crashed.
Right.
I mean, ignore the red ink bleeding across the major indices for a minute.
Yeah.
If you want the true story of this economy, you need to look at the $397 billion in cash that the most successful investor in history is just outright refusing to spend.
It is a staggering amount of money to just park on the sidelines.
It really is. Welcome to this deep dive. Today is Friday, August 7th, 2026, and we are unpacking what has been a violently turbulent close to the trading week.
Yeah, it was definitely a chaotic Friday tape.
For sure. We've got a stack of post-market financial analysis reports from today's closing bell, and our goal is really to help you cut through all that noise. We're looking at a session where a frankly shocking July jobs report broke the whole traditional market narrative.
Completely shattered it.
Right. And it forced this aggressive flight to safety that fundamentally altered where capital's flowing.
Yeah, the velocity of the capital reallocation today was, it was staggering. You just don't see this kind of defensive posturing unless institutional models are pricing in a really severe systemic slowdown.
Like a real recession, not just a blip.
Exactly. The raw data we got this morning, it basically triggered this cascade of algorithmic de-risking across, pretty much every major sector.
And the epicenter of that shockwave was unequivocally the labor data. Going into the morning, the consensus on Wall Street was that the U.S. economy would add roughly 83,000 jobs in July.
Right, that was the baseline.
That was the expectation priced in. Instead, we completely reversed course. The economy unexpectedly lost 23,000 jobs. We didn't just miss the target, we actually contracted.
Yeah, and a delta of over 100,000 jobs between expectation and reality. That is not, a statistical rounding error.
No, not at all.
It is a massive trend break. Institutional portfolio managers, they build their risk models around momentum. So when a macro indicator as critical as employment flips from expansion to contraction this abruptly, the underlying narrative of the American consumer just breaks down entirely.
And what's crazy is Wall Street was actually celebrating this early this morning.
Oh, I know. The initial reaction was wild.
Right. They were cheering the potential for rate cuts based on this data, which, I gotta say, feels incredibly short-sighted when you look at the revisions.
Yes, the revisions are key here.
Because the sources show that May and June saw a combined 103,000 jobs slashed from their original reports. I'm looking at these revisions and thinking, we haven't just stumbled in July.
No, the weakness has been there.
Right. The labor market has been walking with a severe limp for the entire summer. And the initial data collection simply failed to capture that decay. It feels like the Federal Reserve is wildly behind the curve here.
Well, revisions are the silent killers of macroeconomic optimism, right? Like, when you revise down previous months by 6 figures, you strip away that whole illusion of stability.
Yeah, the safety net is gone.
Exactly. It suggests the ground beneath the economy has been softening for an entire fiscal quarter, really masking this deterioration in corporate hiring budgets. So that early morning rally you mentioned, that was just traders operating on outdated muscle memory.
The classic bad news is good news trade.
Precisely.
Where the logic is, a terrible jobs report practically guarantees the Fed will pause their interest rate hikes in September because they obviously can't keep tightening financial conditions if the labor market is actively shrinking.
But see, that logic only holds up if the underlying economy is fundamentally resilient.
Right.
Which we're seeing it's not.
Right. For the last 2 years, markets have been obsessed with the cost of capital. High interest rates compress valuations. So traders were conditioned to just cheer for any data that might force the Fed to lower rates.
Anything for cheaper money. Exactly. But by midday today, all that euphoria evaporated. The market collectively realized that, a Fed pause is irrelevant if corporate earnings are collapsing due to a recession.
Right.
The narrative abruptly shifted from, how much does it cost to borrow money to, will anyone have a job to pay it back?
Which brings us to probably the most deceptive metric in the entire data dump today.
The unemployment rate.
Yes. Despite all of those job losses, and despite the massive downward revisions for the summer, the official unemployment rate actually ticked down to 4.1%.
Which is wild on the surface.
It is. On paper, for a politician or just a casual observer, a lower unemployment rate sounds like a victory.
Yeah, they'll spin it as a win.
But you dig into the crosstabs of the labor report, and the sole reason that percentage dropped is because a staggering 264,000 people completely dropped out of the labor force.
Yeah, they just vanished from the data.
It's like celebrating that you lost weight, But the only reason you weigh less is because you lost your wallet and literally can't buy groceries.
That is a brutally accurate analogy.
I mean, it looks good on paper, but the underlying reason is just bleak.
It is a devastating reflection of the discouraged worker effect. Because, the unemployment rate calculation only includes individuals actively seeking employment.
Right.
So if you submit resumes for 6 months, face constant rejection, and just simply give up, or if you take an involuntary early retirement because your industry is downsizing, you vanish from the denominator of that calculation.
So we are essentially measuring the health of the labor market by ignoring the people who are suffering the most.
Pretty much.
It's basically statistical sleight of hand. And you can see that reality bleeding directly into the consumer sector today.
Let's pivot from the macro indices to the micro realities, because the pain of those 264,000 sideline workers definitely showed up on the tape.
Oh, absolutely. Look at the retail and food sectors. Yeah, look at Wendy's, ticker WEEN. They were absolutely hammered in the broader market today. I mean, they formally withdrew their 2026 outlook and slashed their dividend to fund a turnaround plan.
And fast food acts as this highly sensitive canary in the coal mine for the lower to middle income consumer.
Right, because it's cheap discretionary spending.
Exactly. Discretionary spending at quick service restaurants is literally the first thing to evaporate when household liquidity dries up. If a brand with the massive scale of Wendy's is slashing its dividend, which, by the way, is a massive red flag for income investors,
Huge red flag.
it tells you that the everyday consumer is fundamentally tapped out. They are structurally altering their forward guidance because the foot traffic simply isn't there anymore.
And that consumer exhaustion, I think that explains the sheer violence we saw in the bond market today.
Oh, the bond market was the real story today.
Right. The real panic meter wasn't even in the stock market. It was in U.S. government debt. The 10-year Treasury yield fell sharply today, plummeting from 4.67% down to 4.60%.
That is a huge move for bonds.
A 7 basis point drop in a single session is a massive reallocation of institutional capital.
It is textbook flight to safety. Like, when portfolio managers are staring down the barrel of an earnings recession, they liquidate risk assets. They dump them and flood into sovereign debt just to preserve capital.
Just to keep it safe.
Yeah. A move of that magnitude in the 10-year yield is the bond market screaming that the rate hike cycle is definitively over. And not because inflation is vanquished, but because systemic growth is stalling out.
And we saw that exact same defensive posture reflected in the major averages by the closing bell. I mean, the Dow Jones Industrial Average took the absolute heaviest hit today, dropping 0.85%, closing down at 53,885.
Yeah, it got dragged down significantly by traditional financials.
Right, and we saw international weakness, too, with Bajaj Finance falling nearly 6%. Meanwhile, the S&P 500 fell 0.18% to close at 7,709.
Well, the weakness in the Dow makes perfect sense in this environment.
Because of its makeup.
Exactly. The index is heavily weighted with traditional cyclical businesses, commercial banks, heavy industrials, companies that require a booming physical economy, and consumers eagerly taking out loans.
Right.
So when economic contraction is priced in, those cyclical stocks are the very first to be liquidated.
But, okay, here is where I'm struggling to reconcile the data. The tech-heavy NASDAQ composite was essentially flat today.
Yeah, it held up remarkably well.
It dropped just 0.06%, closing at 26,348. So if we are pricing in a severe economic slowdown, why is tech barely flinching? I mean, tech companies sell enterprise software and advertising to those exact same cyclical businesses in the Dow.
That's a great question.
If the commercial banks and industrials are hurting and cutting budgets, shouldn't Silicon Valley take a massive hit too?
You'd think so, but it really comes down to the modern definition of a utility.
The utility, like electricity.
Exactly like that. In previous decades, tech was highly discretionary. But today, enterprise technology, specifically cloud infrastructure, is as essential as keeping the lights on.
Okay, that makes sense.
If a major corporation is facing a recession, they will absolutely cancel plans to build a new regional headquarters, right? Or they'll delay upgrading their vehicle fleet.
Which crushes the Dow.
Exactly. But they cannot stop paying their cloud computing subscriptions without their entire operational infrastructure just going completely dark.
Wow. So they have this impenetrable moat. It's like a gym membership model, but one you literally cannot cancel without going bankrupt.
That is precisely the right framework. Auto-renewing, Business-to-business subscriptions, they provide incredible downside protection for these tech giants. Investors recognize that sticky recurring revenue and treat those mega-cap tech stocks as a relative safe haven compared to, say, a traditional bank that's entirely reliant on new loan origination.
Which perfectly explains the absolute anomaly we saw in the software sector today.
Oh, Atlassian.
Yes. Amidst all this macroeconomic fear and defensive posturing, Atlassian, ticker TEAM, exploded upward by roughly 36% today.
Just an incredible move.
A 36% move on a mega-cap tech stock in the middle of a market-wide flight to safety is genuinely staggering. It's like that one guy who shows up to a somber, serious dinner party in a Hawaiian shirt and still just has a great time.
That's a great way to put it. The Atlassian print is honestly a masterclass in execution. While the macro environment is undeniably gloomy, they issued a blowout revenue forecast driven entirely by their successful transition to the cloud.
Proving that utility model.
Yes. They proved to Wall Street that their specific user base is fully locked into their ecosystem. When everything else on the tape feels, uncertain, institutional money will aggressively chase a company that proves it can generate reliable, recurring cash flow regardless of the broader economic weather.
So we have capital hiding in sticky tech, and we have capital hiding in government bonds. But the sector breakdowns from the sources show an even deeper layer of defensive positioning.
Oh yeah, the defensive staples.
Right. Healthcare, the XLV ETF, rose 1.3% today.
Because healthcare is the ultimate non-cyclical play. The demand for medical treatments, pharmaceuticals, essential care, it just doesn't fluctuate with the Federal Reserve's interest rate policy or, the monthly jobs report.
People still get sick.
Right. It is deeply insulated from consumer discretionary pullbacks.
And then there's the ultimate historical safe haven. Materials, specifically the XLB ETF, climbed 1.2%, heavily led by gold miners.
Classic fear trade.
Yeah, and specifically, AngloGold Ashanti, ticker AU, skyrocketed 9.46% today on strong free cash flow and elevated gold prices. Now, I understand why gold spot prices rise during times of fear, but a nearly 10% jump in a mining company seems kind of disproportionate. Like, why such a massive premium on the miners themselves instead of just the metal?
It is all about the mechanics of margin expansion. Think about it. A gold mining operation has relatively fixed extraction costs.
Okay.
It costs them a set amount of diesel, labor, and equipment to pull an ounce of gold out of the ground.
Right.
So when the spot price of gold rises due to macroeconomic fear, their production costs do not increase, which means every additional dollar in the gold price flows purely to their bottom line as free cash flow.
Oh, wow. So it's amplified.
Exactly.
Oh.
Wall Street isn't just buying the safety of gold. They are buying the exponential profit multiplier that these miners offer in a high-priced environment.
That makes total sense. You buy the asset for safety, but you buy the producer for the leverage.
Yeah.
Now, I want to present a major contradiction in the commodities market today that the sources highlighted. Because while gold surged, energy was actually the biggest loser of the day.
Yeah, that got a lot of people off guard.
The XLE ETF dropped 2.1%, with crude oil facing major downward pressure. But, according to the geopolitical data, there are currently ongoing tensions in the Strait of Hormuz.
Right.
And historically, any threat to the Strait of Hormuz causes an immediate spike in oil prices due to supply chain panic.
Usually, yes.
So why on earth is energy tanking when a major global choke point is actively under pressure?
It's fascinating, right? It highlights a critical hierarchy in market psychology. Geopolitical tensions threaten the supply of oil, but a recession threatens the demand for oil.
And demand is winning the tug-of-war.
Exactly. Today, the market looked at that 23,000 job loss and extrapolated severe demand destruction. It simply does not matter to traders if the supply of Middle Eastern crude is restricted, if they believe global manufacturing is stalling, and everyday consumers are going to be driving and flying significantly less next quarter.
So the fear of domestic demand destruction just completely overpowered the fear of a geopolitical supply shock.
Without a doubt.
The market is essentially saying that a shrinking American labor force is a bigger threat to oil prices than a disrupted global supply chain.
Which is pretty sobering.
It is.
Yeah.
That is a profound statement about the fragility we are seeing domestically. And honestly, it sets the stage perfectly for the absolute elephant in the room. Or rather, the elephant in Omaha.
Yes, the weekend catalyst everyone is quietly bracing for.
Right. Because the post-market trading session today was relatively muted. Hawaiian Electric, ticker HEE, reported and fell slightly by 0.79%. But frankly, institutional desks are not focused on today's after-hours tape.
Not at all.
Every single eye is looking ahead to Saturday morning, August 8th at 7 a.m. Central Time, when Berkshire Hathaway reports their second quarter results.
The big one.
Yeah. Analysts are modeling for $10.8 billion in operating earnings. But nobody really cares about the operating earnings of their railroad or their insurance businesses right now.
No, it's all about the cash.
The laser focus is on Warren Buffett's record cash hoard, which currently sits at over $397 billion.
It is an incomprehensible amount of liquidity to hold on a balance sheet. I mean, to put that in perspective, $397 billion is larger than the gross domestic product of many developed nations.
Which brings up a structural irony that I just cannot stop thinking about. All day today, we have watched the market panic over a potential liquidity crisis.
Yeah, total scramble.
We watched everyday investors and massive funds scramble into government bonds and gold to protect themselves. Yet, the liquidity exists.
Oh, it's there.
It is just centralized in the hands of a few mega conglomerates like Berkshire, who are sitting on the sidelines waiting for the bottom to fall out so they can act as the lender of last resort.
And that is the ultimate advantage of capital discipline. You know, Buffett is historically known for hoarding cash when he believes equity valuations are completely divorced from economic reality.
When the risk-to-reward ratio is just skewed negatively.
Exactly. By parking nearly $400 billion in short-term U.S. Treasuries, Berkshire is earning a highly respectable, risk-free yield while just waiting for distress to hit the system.
Getting paid to be patient.
Right. They're getting paid billions of dollars a quarter simply to wait for a systemic mispricing.
But it goes beyond just waiting for cheap stocks, doesn't it? Like if the market actually rolls over into a true recession because of this labor contraction, Berkshire is positioned to essentially bail out distressed industries at generational discounts, much like they did during the 2008 financial crisis.
Exactly. That cash pile is not just a defensive safety net, it is offensive ammunition. When credit markets freeze, and traditional banks refuse to lend because they are terrified of defaults, companies desperate for capital really have no choice but to accept draconian terms from the few entities that still have liquid cash.
And we might get the catalyst that triggers that exact scenario very soon. Looking ahead to next week, we have highly anticipated consumer price index data. You know, the inflation print looming over the market.
That CPI print is going to be massive.
Because we just spent this entire deep dive discussing how the bond market is aggressively pricing in the end of the Fed's rate hike cycle because the labor economy is cooling. But what happens if next week's CPI data comes in hot?
Oh, that is the nightmare scenario for the Federal Reserve.
Really?
Absolutely. If inflation remains stubbornly high despite the loss of 23,000 jobs, the Fed is trapped in a paradox.
Right, because they cannot lower interest rates to stimulate the contracting job market because they are legally mandated to keep fighting inflation, which requires keeping rates high.
Yep. That is the textbook definition of stagflation.
High inflation, high interest rates, and a contracting labor force all happening simultaneously.
Exactly. If the CPI print comes in hot next week, it will just shatter this market's newfound confidence that rate cuts are imminent. The Fed will be forced to maintain restrictive policies while corporate earnings crumble.
Which is brutal.
And in that specific environment, the $397 billion sitting in Omaha proves that cash is truly king, while everyone else is just trapped in a deteriorating cycle.
It really puts this entire volatile week into sharp perspective. So, to summarize what the data is telling us today, we witnessed a jarring, undeniable reality check on the American worker.
We certainly did.
The loss of 23,000 jobs, compounded by massive downward revisions for the summer, forced institutional capital to abruptly abandon the whole narrative of a soft landing.
Yeah, the soft landing is out the window.
We watched the market pivot violently from worrying about the Federal Reserve's interest rate policies to worrying about the fundamental survival of corporate earnings. And that fear triggered a massive flight to safety, sending money fleeing out of cyclical sectors like energy and traditional banking and pouring into government bonds, gold, and those defensive tech moats.
The overarching theme is just capital preservation. Wall Street is no longer asking how fast they can grow. They are asking how safely they can hide.
Which leaves us with a deeply unsettling reality to ponder as we head into the weekend for you all. We have nearly $400 billion of institutional capital sitting safely on the sidelines in Omaha, earning a risk-free yield and waiting for the dust to settle.
Right.
And at the exact same time, we have 264,000 everyday people who just completely stepped off the sidelines of the labor market entirely. If the biggest pools of capital are refusing to invest and the foundation of the labor force is actively shrinking, well, who is actually driving this economy forward right now? And what happens when they inevitably hit the brakes?
It is a structural imbalance that simply cannot be sustained indefinitely.
Definitely something to chew on. Thank you so much for joining us for this deep dive. Keep questioning the headlines, keep looking past the surface numbers, and we will catch you next time.